So our cardinal lesson today is talking about QCDs. But when we refer to these as QCDs, people are wondering, what in the world are they talking about? So the title is Charitable Distribution from Your IRA, No Income Tax. Okay, that describes what we're doing is we're making a charitable distribution from your IRA. It's going directly to the charity, and we're not paying any taxes on the money. Okay, there's a bunch of rules, if you want to call them tax traps in doing this, so we're going to go over some of those procedures, but don't do this on your own. Don't try this at home on your own. You really need to get to a professional, and we really want to encourage you to do this. So don't let all these tax traps and systems or places you could make mistakes stop you from doing it. Just get in touch with a professional that understands the rules here. Now I want to go to Tom, and I want Tom to share with us, why are we shooting this video today? Why is this important?
Yeah, I mean, we're doing this video to really show you one of the most efficient ways to do your gifting of money. You have to be 70 and a half. We'll get to that in a second. But there are much better ways to do giving than what most people are doing. Right now, the standard deduction is so high that most people are just filing the standard deduction and they're getting no tax benefit from the gifts they're doing. And that's not generally the reason they're doing the gifting. But if there is a way to get a tax benefit from the gifts you're making, we certainly want to show you how to do that. I do just want to make the point on this video is that the point of this video is not to convince you to start being charitably inclined, to start giving your money away. And so if you're not wanting to do that, that is fine. You're not going to hear us really pushing you to do that. But we have a lot of clients who have that goal. They have that desire to give some of it away to whatever charities. Maybe it's a church, maybe it's an organization that they have a good tie to, maybe cancer research, whatever it is. This is going to be the way. The QCD is the way that you can do that the most efficiently. So let me bring up the show notes. These are down on the link below the video. They're also on our website. Again, like always, we have the board, and then we have some documentations that really just goes into more of the rules and gives you a little more detail about the points we have on the board. I think we'll cover most of this in the show, but if you want to read more about it, certainly go look at these show notes. It gives you some more background on how to do this and how it can be helpful for your situation.
Okay, so the very first point we're going to make here is it's technically called a qualified charitable distribution, or the acronym is QCD. And the rules are, number one is you must be 70 and a half at the time of the distribution to the charity. So a lot of you watching, I'm sure you're not 70 and a half yet. So you might say, what am I watching this for? Well, when we're doing retirement planning and we're meeting you at 65 or 62 or 67, we're sitting down with you and your spouse, and together as a couple, we're planning out the whole of your retirement and your finances and your income and your taxes and your estate planning. I mean, all these things that are on the peripheral of the board. And so when we plan your charitable giving in your 60s, we might be planning to start doing these at 70 and a half. We might even wait till 73 when you hit minimum distributions to start doing these, but they're still part of the plan. So there's something everybody should be looking at. You also, if you're watching this and you're fortunate enough to have your parents still alive, a lot of times people in the age group watching these videos, they're taking care of their parents' affairs, or their brother or sister is. And so if mom or dad are giving quite a bit, or giving whatever they're giving, and they still have IRA money, this is something you might want to look into for them. So 70 and a half at the time of distribution. And some people make this mistake of doing the QCD during the early part of the year when they turn 70. You have to actually be 70 and a half or older at the time of the distribution. So don't make that mistake. Second one is the QCD limit in any one year. It's $105,000. Now, typically, we don't have a lot of clients that have trouble with this number, but there are situations, and to understand, this has an upper limit to it. So you can't take your whole IRA if it's larger than this and just give the whole thing to charity and not incur some taxes. So the top limit is 105 grand, but that's per year per person. This will satisfy your RMD for the year. So a lot of folks will plan out their RMDs, and that's what we're going to do in a financial plan is we're going to show you what they are and what they're going to be based upon some assumptions. And then they will take part of that RMD or the whole thing, and they will do it as a QCD. So now they're giving their RMD or part of it to charity, and they're not going to have to pay the taxes on the portion that's a QCD. So it makes a lot of tax sense, given the fact they were going to give the money away anyhow. Number 4, IRA owner or beneficiary can do a QCD if they're 70 and a half. So this not only works for the IRA owner, but the beneficiary can do a QCD if they're 70 and a half or older. And when we get into all those inherited IRAs and the 10-year rule and the all of that stuff, if the beneficiary is over 70 and a half, they can give part or all of it away as a QCD. So only for the IRA. It doesn't work for 401ks, 403bs, 457s, or a host of other retirement plans. QCDs only work out of the IRA. The next one is it has to go to a qualified charity. So it's not a GoFundMe, or it's not to a person, or it's not into a donor advised fund. It has to go from the IRA directly to the charity. And it can't pass through you and your checking account. And you also can't take a tax deduction for it because you're just avoiding the taxation on this distribution from your IRA. And the check has to go directly to the qualified charity. Now, I want to bring Tom back on, and I want Tom to just give us some thoughts on these 6 points.
Yeah, I mean, I think Hans did a pretty good job of laying out what these points are. A couple of points I want to make on top of that is the QCD limit, the 105,000. That's per year per person, which is pretty straightforward. It is indexed for inflation, so it does grow some over time. So we're filming this in 2024. It could be a little higher in future years, but it's going to be around that number. I do want to point out though that is while you're still alive, right? A QCD is by definition, you're still living and you're giving them the money to a charity. At death, you can name the charity a beneficiary, and then there is no upper limit to that. So a lot of times, if we have people that maybe don't have children, they've taken care of the people they want to take care of, and they name a portion of their estate to whatever charity they're inclined to. Using IRA money to give it away to the charity at that point is a wonderful sort of estate planning strategy. And so that limit does not apply to the beneficiaries of the IRA upon death. So you could do this giving while you're still alive, name the charity the beneficiary of the IRA. When you pass away, it all goes to the charity. The charity doesn't have to pay taxes because qualified charities don't pay any income tax. And it's just a wonderful way to do that. And then the other thing I want to point out is with the idea that it has to be an IRA and not a 401k or 457 or 403b, any plans sponsored retirement plan or company sponsored retirement plan that's important because what a lot of times we'll do, or what we see happen, is people might have some money in their IRA and they've left some money in their 401k from maybe their last employer. And their idea is, why don't I just take money out of the IRA? It will satisfy my RMD for all of the accounts. And that doesn't work. So IRA RMDs are separate from 401k RMDs. And so the QCD out of the IRA can cover that RMD, but it cannot cover the 401k RMD. So that'd be one reason why you might want to consider moving your 401k into an IRA prior to 70 and a half, or I guess really RMD age is the most important. But prior to that age is that there's some reason to put the 401k into the IRA. And so what I thought we would do sort of next, I'll turn it back to Hans, and we'll go over some of these examples of just case studies that we have of where clients have used these QCDs to just as part of their plan.
So the first one we're going to talk about here is Christie. And Christie's 80 years old. She has $250,000 in her IRA. And she's going to give a $5,000 gift to her church. And so if she does that, just the way she would normally is just write a check to the church for $5,000 and just out of her regular money, or even if she took it as a distribution from her IRA, and then she further passed the $5,000 on to the church, she's going to get no tax deduction for that because she uses the 16,550 standard deduction for a single taxpayer. Uh, she uses a standard deduction because she doesn't have that much in deductions. So to exceed that, so she's effectively would get no tax benefit out of the $5,000 she's already decided to give. By doing it as a QCD, she is going to, the 5,000 is going to go straight from the IRA to the church and never touched her hands. She's going to get tax reporting on it. And then she's going to have to make a notation and do a little something special on her tax return. But effectively, she's going to pay no income taxes on that $5,000 distribution. Now, something I pointed out here is if this is the only IRA she has, she's got an annual distribution of $12,500, an RMD, required minimum distribution. So we're going to have to do a little planning around that before we do help her do this QCD, because we want to do this in the right order. And she's going to have to take another $7,500 out of her IRA and pay taxes on it because her minimum distribution is right around $12,500. Now I want to turn it over to Tom to talk about example number 2 here.
So in this example number 2, we have John, who's age 75. He has the high net worth, so he has the ability to give a lot away. But he's structured his income and his assets in a way where even though he has a high net worth, his annual income or gross income is only $100,000. And he really did that around to try to not have to pay the IRMA, the increased cost for Medicare, based off on high earners, essentially. And so he also had this connection with the American Cancer Society. He had a loved one who passed away from cancer. He felt really passionate about this, and he wanted to start really supporting this cause. And so he had this large IRA that was going to cause RMD problems because at 75, he has to take money out of the IRA. There is no choice. The IRS tells you have to. And so it was going to drive his income up. It was going to have him pay extra cost for Medicare, the IRMA, pay a lot more in taxes, pay more on Social Security taxes. I mean, the whole thing was just going to really increase his taxes. And he didn't really want to do that. And so because he had the goal of really helping support the American Cancer Society, we structured it in a way where he was able to give up to, in this case, up to the limit, $100,000 to the Cancer Society out of the IRA. It didn't show up on his tax return. It satisfied his RMD requirement, and everyone was happy, right? He didn't have the IRMA. He didn't pay more in Social Security tax. He helped the Cancer Society, which he wanted to help, and he's starting to reduce his IRA balance. So it was just a win-win in all situations. Again, it's not a reason to give the 100,000 unless you really want to, anyways, because he does have 100,000 less than he started with. But in his situation, that was part of his goals, that was part of his desire, and it worked great as part of his plan. One point I want to make, and this is with all QCDs, is on the tax reporting piece of it. And so you do this, you followed all the rules, it goes directly to the charity out of the IRA. Everything is good. However, on the 1099 that you get from the custodian, whoever sends you the 1099, they will not mark that it was a QCD. That there is no way to report that on the 1099. So it will show up as just a quote unquote normal distribution. When you go to file your taxes, whether you do it yourself or you have someone else prepare the taxes, you need to tell them that that was a QCD, that was given to a charity. And when you're filing your taxes, that's where you acknowledge that went directly to a charity. But I've seen a lot of situations where someone will take the 1099, they'll give it to someone who doesn't really know their whole situation. They don't know what's going on. They give them all the documents, they do all the stuff in, they file it, and they don't really look at it. And they end up paying taxes on this money they shouldn't have to. So just that's a cautionary tale is make sure you are informing whoever's preparing your taxes about that distribution and that it was a QCD, and don't just rely on the 1099 because it will not say anything on the 1099 that shows that it was a QCD.
Now the next example, Mary and Jack, 78 and 75, and they have a gross income of $150,000. They have great pensions, they have Social Security, and they have a big bulk of money in 2 IRAs that they haven't really been spending or using the required minimum distributions. And so they have been giving each year to the church a tithe of $15,000 a year. That's been coming out of this and just going straight to the church. And they really haven't been getting much or any at all tax deduction from it because, like these other examples, or like the first example, they're taking the 30,000 plus standard deduction and they're not getting any real tax benefit for their tithing, and which didn't really bother them. That's not why they were doing the tithing. But when we look at their whole picture and we say, okay, so what you're going to do now, or you're going to consider doing, is you've got to give, you got to do an RMD of $40,000. And you actually have to do an RMD of $55,000, but we're gonna pay you the $40,000 just in an RMD. You're going to pay it to yourself, and then you're going to do, or before that, you're actually going to do a $15,000 QCD to the church. Instead of putting it in the plate every week, you're going to give it to them in January, and you're going to give them the whole 15 grand. The church is going to love you for that. And you're going to have a total QCD of, well, by the time I put all the math in here, I didn't label it all properly. You're going to have a total QCD or of $55,000. So this is assuming that we give the church an extra $40,000 of the whole RMD. Now, whether they actually want to do that or not, I got my numbers a little bit messed up here, but the whole concept is these folks were trying to stay below IRMA. They're trying to keep their taxes low on their Social Security check, and their tithe was from before tax money before. And so after this QCD, they're going to meet their RMD. They're going to meet their church tithe, greatly exceed it if they give the whole thing to the church, and they're going to effectively lower their taxes, and they're going to have more money to spend on themselves because they're getting the full tax deduction for this. So it's a sweet thing. So, and what I wanted to do is go over a couple of points on this. Is that I know of a guy who gave out of his will, he gave $10,000 to the church, just in his will. So that gave him, he gave the church $10,000 just out of his regular savings or out of one of his CDs or money that he had in the bank. And then he gave all of his IRA to his kids through the beneficiary. And so he would have been a lot better off making the church a beneficiary for $10,000 from the IRA and giving that $10,000 that he gave to the church to his kids, because the church doesn't pay taxes. That's why QCDs, any charities don't pay taxes. So I would just highly recommend that you either use QCDs to do your charitable giving, or if you want to hang on to the money while you're alive, name the church or the qualified beneficiary, whether that's the public radio station or the arts or your university. I mean, all qualified charities. Name them directly as a beneficiary for an amount that you want to on your IRA, and they're not going to pay taxes on the money, and give your already paid tax money to your family, because they will have to pay taxes on IRAs when they inherit them. So I want to bring Tom back on. I want to go over the boxes. Is in sake of comprehensive planning, we talked about Social Security a little bit. This whole thing is about IRAs. We talked about income, and obviously this whole video is about taxes. So I'd like to bring Tom back on and just tell you that I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.